got a choice. Do you prematurely tighten and choke off any recovery, or do you take steps to avoid the kind of inflation nightmare that spooks the market? My sense is that we should worry more about inflation over a 10-year time horizon and make structural fiscal reforms that have credibility, and do them soon.
This is Taking Stock on Bloomberg. Gold is the theme today. Do you buy it as a hedge against inflation? My next guest says, well, let him say it. Peter Boockvar, equity strategist at Miller Tabak. Peter, it's good to see you as always.
Hi, Pam.
Good to have you with us.
Thanks.
Gold. Just got through speaking with Ralph Preston of a commodity brokerage firm, also Frank Holmes, U.S. Global Investors. He says everybody's portfolio ought to have a little bit of gold in it. But you're not just about safety here. You're saying there's some fundamental things in the economy that point towards owning gold, right?
Yes, and you mentioned before gold as a hedge against inflation. There's something in the middle there. It's gold as another currency, because it's an unstable currency that gets us to inflation. Inflation is a symptom of a weak currency. And right now we have the Fed obviously printing money, dramatically raising the size of the monetary base in an unprecedented fashion. You have central banks around the world also doing the same. So there's this global race to debase one's currency in order to inflate our way out of this mess. Gold is a beneficiary of that. I don't know of one asset class that is 7% from its all-time record high over the past 6 months. I know of none. Gold is. And I think there's a reason for that, and that is, again, the concerns with fiat currencies and then the subsequent inflation, which the market is betting on, will come.
Now, and I just want to break in here because, you know, just in announcing that you were going to be on the program, you know, we're getting flooded with emails. You got a lot of followers out there, and what they do is they take the same line that you do. They talk about this whole idea of fiat currency and what happens when people in governments all over the world start to debase their currencies. You say, look at gold. They're giving examples of saying even little things like what went on today with Fannie Mae and Freddie Mac raising the limits of what they're going to be guaranteeing.
Right.
Are those the kinds of points you kind of, you know, do you end up keeping a sheet somewhere, you know, on your desk, and you sort of say, these are just more indications of a reason to own gold?
Yes, because each one of these things are costing more money. I mean, Fannie and Freddie, we see their quarterly reports, but you don't know to what extent the government is really providing them with all this capital. And it's AIG, and it's Citi, and it's GM, and it's the Fed's balance sheet more than doubling. The one thing that we have to pay attention to with gold is that Ben Bernanke and the Fed are not going to stop until this economy gains traction. So if this economy falters, if this inventory adjustment that's given people hope that the economy is going to get better somehow falters, we have a double dip, the Fed's balance sheet is going to go to $3 trillion. And they're going to buy even more securities. And they're not going to stop, because once they've gone down this path, they feel like they need to continue until the economy gains traction. So whether the economy falters, they're going to do more. And if the economy gets better, inflation is going to follow us like this dark shadow. The S&P 500 is up 15% since the middle of March. The CRB index, the commodity index, is up 15%. So on a commodity-adjusted, in my opinion, inflation-adjusted terms, the market has done nothing since the middle of March. And this is an inflation-type rally egged on by the Fed's quantitative easing and printing of money.
Well, we've had a lot of people on that talk about the notion that, okay, if the banks aren't lending the money, what are they doing with it? Well, they're buying equities, they're doing a lot of bond trading. So, in a sense, you're talking about this reflation trade. Is that what you think's happening?
That is what is happening. But that's what the Fed wants. There are three different ways of dealing with the debt that we have. You can pay it down, you can write it off, or you can inflate your way out. The Fed has chosen the third. We're paying it down, we're writing it off, but very slowly. And by inflating your way out, by artificially keeping rates low, well, you're preventing the deleveraging process from occurring. If I cut rates to zero, you're not going to pay down debt. You're just going to refinance it. You're going to push it out to 2012 instead of 2010. We're kicking the can down the road. That's what the Fed is doing. We need to extinguish debt in this country, and in many countries, but particularly here. The consumer needs to extinguish debt. But all we're doing is refinancing, a loan modification. It's just a refinancing. People should be renting that can't afford to buy a home or live in a home. We're kicking the can down the road. It's going to be good for gold because there's going to be constantly more printing of money. Is there a certain
irony in the whole thing that we talk about deleveraging on the part of the private industry, yet on the other side, you know, we get what's happening with the U.S. government. They're picking up the slack by definitely not deleveraging.
Right, and there's this to me, this fallacious economic argument that Washington wants to make, that we've seen this big drop-off in private sector consumption and spending. Well, the government needs to fill it up again. Well, we've seen a pullback in spending because the demand is not there. The economy needs to readjust. So the government is trying to put Humpty Dumpty back together again, and it's not going to happen because the consumer can't handle any more debt, businesses can't handle any more debt, and right now the government can because foreigners and investors are buying it, but who knows how much longer that will last.
All right. One thing the government can do, we know, is they can pass laws. And I was talking to Frank Holmes earlier, and one of the things I talked about was in the past, we have had situations where U.S. citizens are not allowed to own gold. Isn't there a possibility that, you know, they're going to say, Peter Boockvar, that trade, that gold trade that you put on, not going to be allowed. We're going to actually pass a law, and we're not going to let you own that gold.
I'll never say no because it happened before. But in such a globalized world that we live in right now, where money can pass through by the click of a button, I don't see how they can even enforce something like that. So
okay, so technology is kind of taken over where the government is left off.
I think if you take this to the extreme of what could happen to the dollar, and I'm not saying we're going there, but take it to the extreme, it'll be a capital control situation similar to Iceland, where you can't necessarily send dollars overseas. And again, I'm not saying that, I'm not being that person saying this is the end of the world.
Not yet.
I'm just saying that we're on a dangerous path right now. And unfortunately, I don't think the Fed fully understands. They're living in this world that there's deflation. Janet Yellen last night said she's more worried that inflation is going to stay low for years. Well, gold is 7% from 1,000, and you have a Fed member saying inflation's not a concern. One of them will be wrong.
All right, and we certainly know where you're directing your clients to put their money.
Yes.
I want to thank you very much. Peter Boockvar coming in from Miller Tabak, as always, insightful and interesting.